Welcome, accounting boffins. You with Ashraf Patel. Accounting is the focus, and we've got our crew with us. What are we doing today? Today we're looking at typical examination questions. Right. Now, before we actually go into the questions, let's take a look at this here. When you're dealing with your exams, remember, paper one will always deal with your financial reporting and evaluation, okay? Whereas paper two deals with managerial accounting, internal auditing, control, etc. However, you're going to find that within your paper, you can get an overlap of these sections into paper one and into paper two. So that's why keep in mind that yes, paper one deals with your financials, but it can also include ethical questions, interpretive data response questions, etc. Right? But remember, paper one is financial reporting and paper two is your cost and managerial accounting. Okay. So now, the financial year ends on the 31st of December 2020. Remember, we're doing an adjustment now. The rent income figure that's given to you in your trial balance is 126,224. Okay? The question now tells you that your rent was received up to January 2021. Take note that the rent was increased by 12% on the 1st of August 2020. Again, let me just give you an overview of the rentals and the types of adjustments that you can get. Firstly, the rental remains constant for the year. Either you've paid, if this was rent income, either you've received too much or you've received too little, right? So it can either be a deferred income where you received too much of rental, or it could be an accrued income where you haven't received for the full 12 months. Right, those are the two possible adjustments with rent income, either deferred or accrued. Then, the types of adjustment. One is the adjustment, the rental stays constant for the year. You've received 1 month in advance, you just divide by 13, no problem. The second one is where the rental increased by a percentage, which is the one we're going to be dealing with just now. And the third one is where your rental increased and they give you the increase per month. Please make sure that you are in a position to calculate all three methods depending on which one is being examined. Right, the one that we're dealing with here is where the rental has increased as a percentage. So step number one, what do? Take note of the following. It was increased by 12%. That's a percentage increase. And when was it increased? On the 1st of August. Right, so therefore, the most important thing here is let your old rental be 100%. Why do we do that? Because we don't know what was the rand value of the rental. What we do know is that the percentage of the old rental was 100%. That is why we make the old rental 100%. Okay, then, the next thing that you determine is for how many months was the rental at 100%. So obviously it would be January, February, March, April, May, June, and July. So these are the old months. And if you count, it's 1, 2, 3, 4, 5, 6, 7. So January to July is 7 months, as I've shown you there, right? Then the increase took place when? In August. Up to when? So very often you find candidates making this mistake. What is the error that they make? August, September, October, November, December, and they stop at December. But no, you've also received the rental for January. And that is why in the new rental you say from August to January. So in other words, your financial year here is January to December, correct? But because you've also received that rental, clearly that's the one out of your financial year. So you can see that the new rental would be from August to January, which would be 6 months, which will be your new rental. Okay, now watch my calculation here. 7 months old rental, watch what we do. We say fine, take that 7 times 100, which was the old, to give you a figure of 700. The new was 6 months, 6 times 112. Where did the 112 come from? Remember, old was 100 plus your new, the percentage increase for the new months was 12%. Therefore, the 112, if you multiply that by 6, gives you 672. So that becomes your new rental in terms of percentages. Now watch what we do, and this is important here. This is very important. We add the old plus the new to give us a figure of 1372 in terms of percentages, and that's what's important. Right, okay, and this is equal to what? In terms of my rental figure, if I pick up my rental figure again, 126,224, here you can see 126,224. Clearly you can see here, that's the percentages and that's the rand value. Okay, now what are you trying to determine? What do you want to find from this calculation? You want to find out what was the January, which one? This one here. What was the rand figure of that January rental? Therefore, you say, because that January forms part of the new, it will therefore be part of the 112. 112, watch, important. Keep your percentages underneath one another, right? So that you don't mix up your calculation. The 112 is equal to my unknown. That's the x that I'm solving for. So watch. In my percentages, there's the 2 percentages underneath one another. There's my 2 rand values underneath one another. So now I cross multiply. 1372x, that's what I do. I cross multiply. 1372x, there we go, is equal to 126,224 times 112. Let's do that calculation there. And we say fine, 126,224 times the 112 divided by 1372, and that will give you 10,304. What is the 10,304, people? That is the rand value of the rental that you received in January. Right. Once you're done with the calculation, that's the first step. You've identified the correct amount for your adjustment. Now, how do you deal with the adjustment? And this is where it comes in now. Remember, deferred income tells you minus. Watch, that's the operation that I need. In my bracket, you start off with a 126,224, which is your given figure, and then the operation tells you minus 10,304 to give you your final figure of 115,920. So this is how it will appear in your statement of comprehensive income. However, in terms of my balance sheet, watch, where does deferred income feature? It features in my trade and other payables, right? Under the item deferred income, I have the figure 10,304. Okay, so this is important. In this particular scenario, you're looking at the impact on the statement of comprehensive income, as you've seen there. There we go. And you're looking at the impact on the balance sheet, namely the statement of financial position. Remember the new names that are being used, so we'll use them interchangeably. Statement of comprehensive income, income statement. Balance sheet, statement of financial position. Okay, so here it goes under trade and other payables, deferred income, 10,304. Another important aspect of this year is when you are doing your adjustments, the first thing that you do is you go to your balance sheet account section to see whether any of the big 5 appear under my balance sheet account section. What am I referring to here? Right? The accrued income, deferred income, accrued expense, prepaid expense, and consumable stores on hand. If they do not appear, you now can continue with your adjustments knowing that the reversals have been done. If they do appear, then you have to take the reversal into account when you are completing your adjustment. Very, very, very important. Okay. The next adjustment says here, your financial year end is the 31st of December 2019. Salaries and wages was that figure. Employer contributions, 85,000. So in this particular example that you see in front of you, you find that your salaries and wages is a standalone expense and your employer's contribution is another expense, also standalone. At this juncture, allow me to also explain that sometimes these are combined. So where you don't find them as two standalone expenses, then you are expected to treat them all as one expense under the umbrella of salaries and wages. Okay, let's look at the example. It says here, your net salary was 92,000, your deductions was 29,000, and your employer contribution was 19,800. Okay, so in terms of my income statement, I start off with my 575,000 given to me, right? There's the 575,000. Watch. Where does the 121,000 come from? And that's the important part. Watch here. If you take your net salary to be 92,000, right? Plus your deductions of 29,000, that will give you a figure of 121,000. So what have we done? We're adding the net salary plus my deductions to give me what we want here as our total salaries now will be 696,000. So that 121,000 is your net salary plus your deductions. Now watch, your employer's contribution was the 85,000. Again, your 85,000 coming from your employer contributions. Here we go. 85,000 was a given figure in my trial balance. So I start off with the 85,000, right? Plus the 19,800 to give me a figure of 104,800. Okay, the next one. And this is important now, guys. What's the impact of that adjustment on my balance sheet? Here goes. You have your net salary as part of creditors for salaries, right? You have your SARS, PAYE, and you have your pension fund. So in other words, what you notice from this year is that you're debiting salaries, you're debiting employer contributions, that's an impact on your income statement, but the credit entries are impacting on your balance sheet, where under trade and other payables, you have all your adjustments in respect of salaries and wages, creditors for salaries, SARS, PAYE, pension fund, etc., medical aid, whatever you have. But in this case here, these are your liabilities. And remember, these are amounts that you owe. Remember, these are amounts that you owe to your creditors. Right. The next one we have here is write off a further bad debt of 5,000 Rand and then adjust the provision to 10,480. So what do we do here? We start off by saying, in my bad debts, start off with my given figure of 9,750, add the 5,000 to it to give me 14,750. This is my bad debts adjustment. Okay, now if I look at my provision for bad debts, firstly, I have a provision of 14,000 Rand. You do remember that provision for bad debts is a negative asset. What do we mean by that? By that we mean it reduces the value of your asset. Which asset? Debtors control. Therefore, debtors control less provision for bad debts will give you net trade debtors. Okay, and you're going to see that when we're doing the balance sheet. So if we're adjusting our provision now to 10,480, they're telling us that in my provision, I had 14,000, I must reduce it to 10,480. That means I must reduce my provision by 2,570. This then tells me that when I reduce my provision, it becomes an income as an item called provision for bad debts adjustment. Remember, that is your nominal account. If I had to increase my provision, then my provision for bad debts adjustment would appear under operating expenses. Okay, so there we go. Now look at your balance sheet. Here we go. Remember what we said? There's my trade debtors, 350 minus the 5,000 first to give me my 345. Then we said provision for bad debts. It's my new provision. Remember, 10,480. So this clearly indicates to you that provision for bad debts is a negative asset. It reduces the value of your asset. Which asset? Debtors control. Look at it. You've got 345,000 as your debtors control, less your provision of 10,480 to give you net trade debtors of 334,520. So in this case here, you can clearly see how that adjustment impacts on both your statement of comprehensive income. What will go in there? The adjustment of your provision for bad debts, either the increase or the decrease. And what goes to your balance sheet? Your final amount, your new provision that you need in your balance sheet is the 10,480. There we go. There it is. And this then completes the adjustment. Okay. Okay, guys. The next adjustment we're looking at is the adjustment on the loans. Remember, this is your loan figure that's given to you, 1,725,500. What else are you told? You are told that you have fixed monthly repayments, including interest, to be 31,600. But remember, it's monthly, okay? And they're telling you that the capitalized interest amounted to 242,500 for the year ended 29th of February. Interest for the next financial year is expected to be 162,000. Part of the loan will be repaid within the next financial year. Right, so now, what do we know? Look at our loan account. I always ask learners to draw up the loan account so that you can see, put in the information, and then it becomes much easier to complete your balance sheet. Here goes. Your opening balance, 1,725,500. There's your bank, 379,200. Remember, what was it? It was the 31,600. 31,600 times 12 will give you 379,200. There's the 379,200. Okay, the interest was 242,500, given figure. So your closing balance is 1,588,800. However, now watch this here. Here's my loan as it should appear in my balance sheet. I start off with my opening balance minus my repayments plus my interest. Now, you were told something very important here. Interest for the next financial year is expected to be 162,000. Right, so this is what we're going to now do. Watch this here. We're going to take the figure of the payment. Where's the payment? Here we go. Of 379,200. Right? We've got the 379 minus the 162,000 which we were told. Let's identify that figure first. 162,000, right? Let's take the 162,000, 162,000, and there we go. No, that's wrong. Let's get the figure right. 162, 123. That will give you a figure of 217,200. Can you see? That's where we're getting the 217,200 from. That is the portion of your short-term loan. In other words, you're expecting to pay a certain amount next year. So what do? You take last year's capital repayment, the total figure, the bank figure, the 379,200, minus the interest you expected to pay to find out what will be your capital repayment. Okay, guys, that's it for the adjustments. Let's take a quick break. When we come back, we'll start with a new question. See you just now. Welcome back, accounting boffins. We're busy with accounting examination questions. Once again, just an indicator for you in terms of paper 1 and paper 2. Remember, in paper 1, you're dealing with financial reporting and evaluation, whereas in paper 2, you're dealing with managerial and cost accounting, as well as internal auditing and control. We did say there could be integration with regards to GAAP, ethics, IFRS, etc., etc., etc. Okay, here we go. When you are dealing with stock in a manufacturing concern, right, there are 4 accounts that you deal with. What are the 4 accounts? Number 1 is your finished goods stock. Number 2, your raw materials stock. Number 3, your indirect materials or consumable store stock. And the 4th one is your work in process stock. Right, okay, so now, when you're dealing with finished goods stock, what are we dealing with? These are products that are completely finished and are ready for sale. In other words, these goods are the same as the trading stock of a retail business. In other words, these are goods completely manufactured, waiting in your warehouse, ready to be sold to the wholesalers. They are the trading stock that you've completely manufactured. The same as a trading stock of a normal retail concern. Keep that in mind. That's what we mean by finished goods. Okay, the next one is your raw material stock, the unprocessed materials used to produce finished goods. The finished product of a company can be the raw materials of another company. Example, flour produced by a company will be the raw material for the company that produces cakes. Simple. If you look at it this way here, your raw material stock is what you're going to be using to manufacture your product. So the example that we gave you here is that flour is manufactured in the mill. It would be their finished product, but for you as a bakery, it will be part of your raw materials in terms of processing your baking that you need to make in terms of bread and cakes, etc. So just keep that in mind. Okay, the indirect materials account that we're dealing with here is the stock that has not been used but is available for use. Example, your cleaning materials, right? These are indirect materials, okay? How they are apportioned, whether they are used in the factory or they are used in the selling and distribution part, or whether they're used in the admin section, will depend entirely on the question. You will be given a heads up as to how to use it. Your work in process stock account. This guys is the most important. It's your manufacturing account. In other words, it deals with the following. Number 1, products that have not yet been completely turned into finished goods and are still in the manufacturing process. These goods are partially completed at the end of the accounting period and are worth more than your raw materials. So in other words, these would be your opening and your closing balances in your work in process account. Remember, when you walk into a factory at the beginning of the year, you get some goods that are not totally manufactured. They're in some state of manufacture. And by the same token, at the end of the financial year, you're going to get some goods that are not completely manufactured. So your work in process will have an opening and a closing balance. Right. If we now look at our information, we are told that Sihle Sengwani owns 2 separate factories that manufacture products according to orders received. There is no work in progress stock. The year end is the 28th of February. So in this case, they're telling you there is no work in process at the end of the year. All right. Indicate whether the following statements are true or false. Okay? The wages of the factory cleaners is a direct labor cost. Okay? Think about it. Wages of whom? The factory cleaners. That means they're not directly involved in the manufacturing process. Therefore, you can clearly see this is not a direct labor cost. So therefore, the statement is false. If you have to correct this statement, what will you say? You'll say wages of the factory cleaners is part of factory overheads. Okay, next one. The delivery cost of finished goods to retailers are selling and distribution cost. Okay, delivery cost of what? Finished goods certainly would form part of your selling and distribution cost. So obviously this one will be true. The next one we have here, indicate whether the following statement is true or false. Depreciation on office equipment is an administration cost. Think about your 5 cost accounts, right? You got direct material, direct labor, factory overheads. Those deal with production. Then you got your selling and distribution and your admin cost. Those deal with the profit and loss. Okay, so now this question says depreciation on office equipment, part of admin cost. Certainly this is true because your office equipment is used in the office. It's part of administration. Therefore, that cost component would fall part of your administration cost account. Okay. We now have to complete the factory overheads cost account note. This is the information that we have. We have indirect labor, depreciation on factory plant, advertising, water and electricity, rent expense, insurance allocated to the sales department, and your factory sundry expenses. Okay, we know that we are told the following adjustments to factory overheads must be taken into account. Water and electricity for February 2020, 18,000 Rand must be taken into account. 80% is allocated to the factory. The balance is an administration cost. Okay? Then we are told that the rent must be allocated according to the floor area. 810 square meters for the factory. Office 180 square meters. Sales department 90 square meters. 75% of insurance must be allocated to the factory. The balance applies to the sales department. Okay, let's go into the adjustments and see how we now have to deal with each of the items. Right, if we take our factory overheads cost, firstly, let's pick up the indirect labor. There was no adjustment for it. Therefore, it will go as is. Indirect labor, let's identify. Indirect labor is part of my factory overheads. An example of indirect labor would be the factory cleaners, the factory foreman, right? People working in the factory but not actively involved in the production process. They're not part of the production line. Therefore, that cost component will go to factory overheads. So we've got indirect labor, and there we go, 296,500. The next one we have here is depreciation on factory plant. The moment you see the word factory allocated to a cost, immediately tells you that that has to do with the factory and therefore a factory overhead. So therefore we take it and include it in my factory overheads. Depreciation on factory plant 166,000 as per the given information. Now we come to the first adjustment. We are told about the water and electricity. There's an amount of 18,000 Rand outstanding. So step number 1, look at your water and electricity. Firstly, pick up the amount from the given information, 248,000. So we start off with the 248,000 plus the 18%. However, if you look at the adjustment, we are told that only 80% is allocated to the factory. Therefore, what are we going to do here? We're going to take the figure of 18,000 Rand, right? Let's do that. 18,000 Rand times the 80%, okay? And that will give me a figure of 14,400, right? So now, this figure actually gives you the 14,400. Let me just show you the calculation so you can see. If you take the 14,400 plus your 248,000, right, will give you a figure of 2,622,400. So we've got the total water and electricity, right guys? Let's just do this again. That component was the 14,400, but the 248,000, we didn't take that one into account. So if you take 248,000 times your 80%, okay, that gave you 198,400 plus 14,400. This will then give you 212,800. As you can see, there's my... So this water and electricity figure of 248,000 was the total amount. You had to take 80% of that plus 80% of the 18,000 to give you your 212,800. So in other words, what are we saying here? Look at the expense and then allocate it according to the different department. Is it a factory? Is it admin? Is it selling and distribution? So there's your water and electricity sorted out. Next one that we have there is that your rent must be allocated according to the floor area. Once again, what we do here is take your factory rent. Now, the simplest way of doing this is to take your factory rent, which was 345,600, okay? Take your 345,600, tell yourself, how many square meters do we have in total? Right? Here we go. Let's look at our square meterage. It will be 810 plus 180 plus the 90 will give me a total of 1080. So what do we do now? You take the full amount that you have here. As you can see, 345,600 times 810 over 1080, and that will give you your 259,200. So what do you take? You take the rent amount and you find out what square meterage was used by the factory over the total. And that's important. Watch. It's 810 used by the factory out of a total of 1080. That gave me the 259,200. Okay. The next one was the insurance one. What were we told about the insurance? Let's look at the insurance. 75% of the insurance must be allocated to the factory. The balance applies to the sales department. Okay, now in terms of my information, I'm told here that, here we go, insurance allocated to sales was 12,600. So here, if you're doing your calculation, notice that the 25% was equal to the 12,600. You wanted the 75%. Therefore, you take the 12,600 times 75 over 25. Watch this one here, guys. The amount that was given to you for the sales department, this is important. 75% of the insurance must be allocated, but this is the important figure. Watch here. Insurance allocated to sales. In other words, this is your 25%. Can you see that? So when you are doing your calculation, remember it's 12,600 times 75 over 25. You've got the 25% as your known. You want the 75%. Therefore, you do that calculation to give you the 37,800. Add your total factory sundry expenses, and your total amount is now 1,080,000. Okay. Yes, we have additional information here with regards to our desks and our chairs, right? There's selling prices. We are now expected to calculate the total cost of production of finished goods. What will we take into consideration? One, you take your three components: your direct labor, your material, and your factory overheads. Watch here. If you're taking your material, they told you was 3,060,000. So there we go. You got your direct material. Your direct labor was 1,440,000. Let's see how we're going to identify our labor. There's our labor. They told you it's 160 Rand per unit, right? And we also know that we manufactured 9,000 units, right? Okay. And if you now take the 9,000 and you multiply it, you're going to find that you're going to get your figure of 1,440,000 as your direct labor component, and remember your factory overheads, you've calculated your factory overheads to be 1,080,000. If you now add the three components together, right, you have your 3,060,000, 3,060,123 plus 1,440,123 plus 1,080,123. This will give you your total cost of production of 5,580,000. Okay, we have to calculate, do a calculation to confirm the break-even point. Firstly, what do we know? What's our break-even point? Let's look at the financial indicator. It's your total fixed cost, right, over your contribution per unit. What is your contribution per unit? Selling price per unit minus variable cost per unit. Let's look at it here. In terms of our required, there's your total fixed cost, right, which has the two components, which would be your fixed cost will be your factory overheads plus your admin cost. Add the two divided by your contribution per unit. What do we know? Our selling price per unit, right? Let's find our selling price per unit. Here we go. 390 is my selling price per unit minus my variable cost per unit. Again, let's identify my variable cost per unit. Here we go. There's your variable cost per unit. If you add, you're going to find that if you add this here, your three components, 250, 310, 250, 310, 380. Let's see if we have that figure as we, let's not go, no. Let's get our figures right. Our variable cost will be material 1. Let's use a different color, guys, so we can clearly identify our variable cost. It's my material as my variable, my selling and distribution. Oh, but it's given to us. We don't have to calculate it. Sorry, here's it, guys. It's given to us. There it says total variable cost. I'm just saying, let's just identify this quickly. What are my variable costs? Material is variable, labor is variable, and selling and distribution are my variable costs. What are my fixed costs? Admin costs and factory overheads. But look, in this question, they gave you the total variable cost, so you can see it. There it is, 305. Therefore, in my calculation, it's my selling price per unit minus my variable cost per unit to give me a total of 18,070. Look at my information. Here we go. There is my break-even point. So what have I done? My calculation has proved that my break-even point is correct. To conclude this segment, very important, know your break-even point. Also know what it means. What does the break-even point means? It means the point at which your profit or loss is equal to 0. So if you manufacture above the break-even point, you're making a profit. If you manufacture below the break-even point, you're making a loss. So what is my break-even point? Once again, it's my total fixed cost, which is my factory overheads, plus my admin cost divided by selling price per unit minus my variable cost per unit. Another name for that is called the contribution per unit. Okay, guys, let's take a break. When you come back, we'll look at another examination type of question. See you just now. Welcome back, accounting boffins. Right, examination questions. What are we looking at this time? Something in paper 2. But before we go there, a quick recap. Remember that within paper 2, you're also going to get questions on ethics, right? Remember with regards to internal control, you also get international financial reporting standards. All of that would fit into internal auditing and control. Right, so with regards to the question, we are told here, you are provided with information relating to STUT Limited. The financial year end of the business ended on the 31st of July 2020. Okay. Question says, provide 1 point why it is a good idea to compare actual figures against budgeted figures. Now remember, we're dealing with a question on budgets, which falls within the ambit of paper 2. The question says, why must you compare actual figures with the budgeted figures? Here goes. 1, to reflect on whether your projected receipts and payments have been realistic or well controlled. What did we say about the budget? We said the budget is a projection. Remember, it's a forecasting tool. So you have to compare your actual with your budgeted to see whether or not it was well controlled, whether it was realistic, etc. To improve future projections. Yes. To take into consideration. Yes, this time we didn't do too well with these projections because of these factors. So now let's take them into consideration when we budget, when we draw up the next budget. To determine variances, very, very, very important. To determine variances between projections and actual amounts, to be able to control the receipts and payments on a monthly basis. So what do we mean by a variance? A difference between actual and budgeted. You get a positive variance and you get a negative variance. Obviously, depending on the situation, it doesn't always necessarily mean that a positive variance is a good variance. You'll see when we actually do a few examples based on variances. Okay, identify 2 items that were incorrectly placed in the cash budgets. Let's look at items here. Salaries and wages, perfect. Vehicles bought on credit. Clearly you can see credit transactions do not feature in my cash budget. Why? A cash budget, you think cash. You think receipts and payments. Clear? So, if you bought vehicles on credit, it will not appear in your cash budget. The next one, payments to creditors, yes. Cash purchase of stock, yes. Depreciation. What can you tell me about depreciation? Remember, we've discussed depreciation at length in many of our other lessons. Let's define depreciation, right? We know 1, it is an imputed expense, meaning it's a book entry. And number 2, we know it is a non-cash item, meaning it does not impact on the flow of cash. Therefore, depreciation will not appear in my cash budget. Depreciation will appear in my projected income statement. Clear, guys? So depreciation is a non-cash item like bad debts. It will not feature in my cash budget. So we've identified payments to creditors as 1 and depreciation is the next one. Advertising, yes. If it was paid for, it would appear in my cash budget. Okay, so I've identified the 2 items that were incorrectly placed in my cash budget. The question says, your June salary was 135,000, your July salary was 151,200, right? The question says here, calculate the percentage increase in salaries and wages. Okay, what are we going to do? Step number 1, take your new salary or the July salary to be 151,200. So let's take that. 151,200 minus June salary, which was 135,000, to give you, right, a figure of 16,200. Okay, so what have you did? You've ascertained or you've calculated that the increase in the salary in terms of rands was 16,200. Got it? Okay, now take the 16,200. Watch, there we go. 16,200 over what was my base? The previous month's salary was 135,000, so over 135,000, here we go. There's the previous month's salary. The increase was 16,200 over the previous month's salary times 100 over 1 because we want to express as a percentage. Let's do that. We take 16,200 times 100 divided by 135,000, and voila, you get an answer of 12%. That means there was a percentage increase of salaries of 12%. Just on this 1 year, although the question doesn't ask for it, you could be given the percentage increase and be asked to calculate the amount as well. So keep that in mind. Okay, next question. At the end of July 2020, you identified the following when comparing budgeted against the actual. Remember what we said? What we alluded to earlier in the lesson? We said actual and projected variance. Here goes. Your audit fee, you budgeted 75,000, but your actual was 175,000. Advertising, you budgeted 30,000, your actual was 0. Right. Clearly you can see this 1 year, audit fees, is a negative variance. A negative variance, meaning your actual was more than your budgeted. Your advertising, on the other hand, was a positive variance because you budgeted 30,000, but you spent 0. Okay, now let's discuss each item. Explain in each case what the effect will be. So, firstly, if you're looking at this one here, it says here, it's actually, our problem should be, our budget should be the audit fee here. Let's just correct this here. Right? So one, we under budgeted or we overspent. It could mean poor internal auditing resulting in a longer and expensive external audit process. Remember what we're saying here, guys, that the internal process is done within the company, and obviously the external process is done outside the company by an auditing firm. Okay? Advice, we could change our auditors. Audited twice will eliminate fraud and assure the shareholders or the partners or the owner that the investment is protected against any fraudulent activities, improve the internal audit. We need to appoint an internal auditor who would set up efficient internal control processes that meet standards of external auditors. Okay, so although we're now talking about internal audits and external audits, which obviously applies more to grade 12 work, but as a grade 11 accounting student, you also need to know that an internal auditor is appointed internally by the firm who works for the business, whereas an external auditor is appointed outside the firm and he reports to the shareholders when you're dealing with companies. So we just thought a bit of extra, although you don't have to know about companies, but it's good to know. It increases your knowledge on the subject as well. Right. Again, the problem with advertising, we budgeted 30,000 Rand and we haven't used it. That means we underspent the budget, or it's a positive variance. Does that mean it's good? Not necessarily. Look at the reason why. Consider the implications of not advertising. It is important to advertise in order to attract customers and possibly improve sales. Definitely, right? I remember somebody telling us one day in one of our discussions that if you do not advertise, it's like winking at a girl in the dark. She can't see you. So obviously, if you do not advertise your wares, you're definitely not going to attract your customers. And it's going to have a direct impact on your sales figure, right? So what do we have to do? Use the budget more effectively to improve the sales, or adjust the budget if found to be ineffective. Yes, certainly use what you have budgeted for. So if you've budgeted 30,000 Rand for advertising, revisit the budget and see, okay, 30,000 may be too much, reduce it. But you can't reduce it to zero, because definitely you need to advertise in order to attract customers and consumers to your business. Yes, 30,000 may be too much. Reduce the budget to 50% of it, which would be 15,000 Rand, but whatever you budget for must be used in your budget period. Okay guys, in conclusion, you've seen in today's lesson where we've given you a variety of questions to give you a flavor of what could be in your exam paper, right? So make sure before you prepare for your accounting paper 1, know exactly which topics will be examined so you prepare accordingly. Notice what appears in paper 2, prepare accordingly, right? In conclusion, do as many past papers as you can, because the more you practice, the better will be your preparation for an exam. And yes, when you walk into an exam, remember you must have BMT. What do we mean by BMT? Big Match Temperament. And how do you build your BMT? By practicing on your past papers, activities, and working in such a way that you are adequately prepared for the exams. What are we going to say? You're going to aim for the moon. And perchance, if you don't get there, you're definitely going to be Ashraf's shining star. Until the next time, be good.